Good morning and welcome to this special edition of Investment Insights series, in which we'll be looking at the recent changes in the SARB foreign exchange limits or foreign exposure limits and trying to tackle some of the questions that are front of mind with advisors, investors, professional investors alike. My name is Robin Johnson. I'll be your host for today. We're going to begin with a presentation by Jannie Leach, our Head of Core Investments. And he's going to take us through some of the research that he's conducted to help us answer the question that what is the optimal exposure to international assets within a retirement portfolio? Follow this. I'm absolutely delighted to have with us Dave Foord and Murray Winckler, two highly experienced portfolio managers that will help us tackle some of these burning questions as well. Now, you'll see on the top left of your screen there that there's a button that you can click for questions. Please send through some questions for any of our panelists, and I'll try and ask them as we go through. So I'm going to bring up a slide now. I hope you all can see that. So what are the changes we're talking about? Well, there's been a change to the ManCo level or the management company level, whether that's a CIS manager, a life wrapper, a LISP, a platform, or even a pension product. There's been a change at that level, and that's what you see in the dark green there. The previous limits on exposure to offshore assets or your asset swap capacity was 40% in offshore, so global, anywhere in the world, and 10% in Africa. And then for retirement funds or Reg 28 through the Financial Services Act, the limit was only 30% to offshore and an additional 10% to Africa. Now, in the recent circular that the FSB put out on the 23rd of February, those limits have gone away now, and they have been combined into a single offshore limit of 45%, both at the ManCo level and at the retirement fund level as well. So does this mean that managers are going to rush to move straight to this 45% level? What are the implications on doing that? I mean, it's a significant change if you were previously at your limit of 30% and you can now add another 15. That's a 50% increase in your offshore exposure almost overnight, and that's allowed by regulation. But how many people have done that? What's the impact of doing that immediately? At this point, I'm going to hand over to Jannie to take us through a short presentation before I get stuck into the other gentlemen on my panel to test them for some questions that you may have and I may have for them. So Jannie, over to you.
Thanks a lot, Rob. So, I think as a starting point for this particular presentation, I have to say that this is for buy and hold investing. So, the way that we run our core funds is based on having a long-term strategic asset allocation. We don't do any tactical asset allocation. We only make use of market cap indices. And the reason for that is if you look at, if you decompose the long-term equity market returns, you sort of see that the longer the investment horizon, the smaller the impact of the starting valuation. In fact, when you get to 30 or 40 years, it becomes quite negligible. When you look at investment periods like that, which is typically what most of your retirement fund investors are exposed to, things such as cost and taxes play a significantly bigger role than what those starting valuations are. And so the way that I framed the solving of this particular question of how much offshore is really from that long-term investor's perspective. Now, an important starting point in answering this question around how much offshore is to understand your home bias. Now, the home bias is basically how much of your assets is invested within your home market. And you can see on the slide there on the right-hand side, we've looked at the various pension fund allocations to home markets across the world. And if you look at the US, about the typical pension fund has got about 62% of the total equities in US equities, which is about 1.2 times the weighting of the US within the FTSE All-World Index. When you look at other developed countries such as the UK, Japan, and Canada, you see those numbers are about between 4 and 7. Australia, on the other side, that's got a very small market cap, but also has a very high allocation to equities. It's sitting at about 26. And then lastly, we've got South Africa, where about 65% of equities are within SA, and of course that was because of the 30% constraint due to Reg 28. You can see that's a whopping 130 times the market cap of South Africa in the FTSE World Index. Now, with the changes to 45%, that number drops to about 52, 53%. So we'll have a similar kind of allocation to domestic assets as Australia, but of course our market cap is significantly smaller, which still means that we'll be holding 100 times the weighting of the FTSE All World Index within our pension fund assets. So it's quite an important one to understand that as your starting conversation. Now, the second part of the conversation is around understanding the role of global markets. So I mentioned earlier, this is from the perspective of a buy and hold investor. So when you're looking at the SA market, you are constrained to 140 shares. We've always had some form of concentration risk in our market, whether it be single securities such as Naspers in the equity space or Growthpoint in the property space. We've had concentration within certain sectors. If you think of the resources, I mean, many, many moons ago, we used to get these half-weighted resource indices. And of course, about 20 years ago, the JSE launched the shareholder-weighted index specifically to deal with the resource problem. And then, of course, within any domestic market, you have to deal with a specific regional risk, political, economic, currency, etc. If you compare that to global markets, you're getting at least between 3,000 and 9,000 shares if you're dealing with the large, medium, and small cap shares globally. You get significantly greater diversification across sectors, currencies, and regions. And it's by far the most effective way to reduce that concentration risk. If you sort of think of that long-term buy-hold investing, you are getting the benefit of thousands of businesses, earnings compounding over time. And as John Bogle so aptly put it, the relentless rules of humble arithmetic. It is long-term compounding in the end that gives us that long-term growth. And that's why the tax considerations become so important. So how much you give up on taxes and on cost can erode a significant amount of the returns. And so in trying to decide your allocation between local and global, understanding the tax implications becomes really important. And then, of course, from a liability perspective, where you are withdrawing an income, the volatility of the rand has also got an important role to play. Now, what we've done is we've looked at a typical balance mandate, as balance mandates are typically used within pension funds, and it's definitely representative of where most South Africans would have a investment. We've got the global, or almost what I say, the no home bias version of our balance fund called the Core Global Fund. That basically is as per the MSCI All Country World Index. It's equity carve-out, and similarly the bonds, properties, etc. Our diversified fund is our stock standard balance fund. So up until now, it had about 70% of its assets in SA. And what we did is we ended up combining these two portfolios to sort of get 4 different portfolios with 4 different levels of offshore exposure. We then went and analyzed 4 components to this question. The first one being concentration risk, the second one being the impact of taxes. The third one is dealing with income withdrawal. And the fourth one, I can't remember right now, but we'll get there in event. I'll start with the first one. So the first one you can clearly see, if you have no home bias there on the left-hand side. In other words, all your exposures is global. You can see that your top 10 exposures only about 10%, and your top 100 exposures sitting at about 30%. If you compare that to a stock standard balance fund, you're sitting with just over 20% in your top 10 and just under 60% in your top 100. So you got significantly more individual share concentration risk than by having more offshore. At that 50% mark, which is where the regulation is sort of tending towards, you can see that that top 10 is sitting at about 16% and the top 100 is sitting at about 45%. The second part of the conversation, of course, is taxes. So there are 2 parts of in this tax conversation. There's the fixed taxes, so that is the security transfer tax. So the more you trade and buy shares in your portfolio, those kind of taxes will be increased. And then, of course, there's VAT, which is linked to the fees that's being charged. So the higher your fees, the higher the VAT. Then there's the variable investment-related taxes, which is your dividend withholding taxes. It's the tax on interest and income. And then, of course, there's the capital gains. Now, we've taken all these taxes and we've gone and sort of like quantify them for those 4 different portfolios. We haven't looked at capital gains as all 4 of those portfolios will basically have to incur a similar kind of a rate, or it'll be the same rate for that capital gains. Now, we've looked at both discretionary and compulsory investments because they are treated differently from a tax perspective. Now, on the left-hand side, you can see our core global fund. We spend quite a lot of time in structuring it as tax efficiently as possible. We make use of Irish domiciled funds, which benefits from the Irish double tax treaty. None of the interest and income is distributed. So we've tried to sort of like structure it in the most tax efficient way possible. And so you can see whether you're in a unit trust or within a tax exempt wrapper, such as a tax-free investment, your reduction in annual yield is sitting at about 0.3%. If you compare that to a standard balance fund that, of course, holds a lot of SA-based bonds and cash instruments, if you are a high marginal tax player that has already used your interest rate exemption, you can see a reduction in returns of up to 0.9% per annum. If you only getting the dividend withholding taxes reduced, that is at 0.37%. So that's the 20% dividend withholding taxes. Where you see the big advantage of holding South African assets is really in the compulsory space, where it's only really the offshore assets which don't benefit from the local tax exemptions that filter through into the equation. And so you can see at the 30% offshore level, that's about 0.1% reduction in annual return, and at the 50%, it's about 0.16. So clearly there's some benefits to where you make use of your offshore investments and where you make use of your SA-based investments. The third part, that's the part that I forgot, which is the volatility. So, of course, one of the major concerns of for a lot of financial planners specifically is that if you increase the offshore allocation, what is the impact on volatility in terms of returns, sequencing risk, and especially when you're dealing with people that are retired, that are withdrawing an income. And so we've gone and calculated what those range of returns are. And like I said before, these range of returns, of course, are for globally diversified portfolios. So when you're taking on individual risk in specific individual markets, regions, and currencies, these range of returns, of course, will be different. But what you can see is that the range of returns up to about 50% is actually very similar to at the 30%. In fact, it's marginally narrower. As soon as you get to closer to the 60% in offshore assets, that range of return widens. And that's basically because your exposure to the currency has increased, and at some point that will be one of the biggest drivers in volatility in the fund. As you can see with the fund that's got no home bias, that range of returns is quite a bit wider. So these range of returns, of course, are over the 5-year time horizon. That's usually used as the minimum investment horizon for a balanced kind of fund. And then the last analysis we did was on withdrawing income. So again, quite a big fear is the increase in the offshore would lead to more volatility and therefore have implications when you're withdrawing income. As our analysis show with the reduction of volatility, when you're actually withdrawing from a portfolio that has got slightly higher offshore assets, you actually get better probabilities. It is, of course, dependent on the withdrawal rate. So we made use of a 5%. We've recently gone and tested it for 7.5 and for 10. The probabilities are still attractive at 50 and 40%. And that's why we've broadly found for living annuities, the ideal exposure is sitting at about 40 to 50%. And so, in summary, offshore investing is definitely the most effective way to diversify your investments. And if you think of that, like I said, the buy and hold investing is that you are now getting the income stream of over 6,000 shares as opposed to just 140 shares over time. And then, of course, the compounding on those earnings. In terms of deciding where to use your offshore allocations and your local, unit trust, for discretionary investments offshore, especially tax efficiently structured offshore vehicles, is the preferred investment. And then, of course, within your retirement vehicles and your tax-free investment structures is where you get the benefits for your SA-based investors. And so what we broadly found for like I said, a buy and hold index fund kind of portfolio is that you want between 40 and 50% in offshore assets, given the fact that your balance fund is used by living annuity clients, people saving for retirement, and in some cases, pre-retirement. Just as a final note, so what we did is we applied some of those rules to a sort of like a cradle to grave framework. So as you start saving, making sure that you start allocating towards the right buckets. You can broadly see for your short-term liabilities, you're looking at less than 40% offshore. So that's typically going into a core guarded or stable kind of fund. And then your long-term liabilities, like your retirement fund, you're sitting at the 40 to 50. And then the long-term wealth creation really is where you want to get the benefit, like both the tax and the diversification in terms of having your money offshore. Rob, that's it from my side.
Well, thanks very much, Jannie. Whistle-stop tour. I know there's a lot of research and work that's gone in behind all of that, and we're talking 2 or 3 years worth of work behind these slides. So thank you very much for summarising that in a short period of time and really honing in on the key aspects that people need to be thinking about. So at this point, I'd like to bring in my other guests. Welcome, gentlemen. Dave Foord, co-founder and portfolio manager of the Nedgroup Investments Stable Fund, so founder of Foord Asset Management. Thanks for joining us.
Good morning, Rob. Hello, everybody.
And Murray, co-founder of Laurium Capital and portfolio manager of the Nedgroup Investments Stable Fund, SA Equity Fund, amongst others. So once again, thank you for your time. I know it's massively volatile period out there in the markets at the moment, so I really appreciate you taking the time. But we are really conscious that there's a lot of questions about this recent change in regulation. So, Dave, I'm going to come to you first, and I'd like to ask you what are your initial thoughts on this change in increasing the limit, and does this instigate an inevitable change in the strategies for these Regulation 28 or retirement-focused portfolios?
Very much so, Rob. It's a big move, and there's a long history behind it. We used to have very tight exchange controls, and the administration here has been put under pressure to open up. And so I think this move is coming from the international community, the Bank of International Settlements, IMF, World Bank, etc. And it's great to run an economy where the price of the currency is made in the market. And so we've got a market-related economy. There's no reason why our currency shouldn't be market-related as well. But a move from 30 to 45 is big, and it's great for savers. It means you've got more choice in lots of different ways. So we have been able to invest some rand protection in the local markets in different ways, but to be able to invest what we think is the right amount, 60% offshore, getting closer to that now, but we can do it with pseudo rand hedges or companies listed in SA which are global. But now the choices are bigger. Just a simple example, on the property side, there's only Capital and Counties listed here, but now we can invest in lots of other counters in the property side. So it's just not just about equities. So it's very important what's going on, and there's lots of choices that are going to come through here. And are we going to just go straight to 45? No, because you need to balance out the risks, the rewards, and the different things that are happening in the global economy. And I'll answer some questions on that just now, if you like.
Okay, thank you. I'll stick with you for my next question just quickly. So obviously you manage the stable fund, but will it have a different impact on low equity, medium and high equity portfolios in terms of your thinking or what people need to think about in terms of their allocation?
It affects us in lots of different ways. We've got the other limits that come in as well, 75%, 60% and 40% in equities, in the high equity, middle and lower. So we've also got a situation where we have funds overseas, but we're only allowed in CIS to put 20% of assets into another fund. So there's constraints like that. Because of the opportunity set and where the opportunities are likely to be up to now, it's mainly been equities, and everybody's in the industry has basically put 30% offshore into equities. We've had more a balanced fund approach internationally. But now I think there's going to be more opportunity to do proper asset allocation instead of just blindly putting 30% into equities. We'll be very active in that other 15% into property, bonds, etc. But the opportunities are different. You need to match your expected returns in SA. So we're absolute return investors. We're trying to defeat inflation. Now, the rand has depreciated by 5% per annum over the last 25 years. And I would suggest it's no coincidence that our inflation rate has been 5% over the last 25 years. So taking money offshore gives you an immediate inflation protection, ceteris paribus.
Right.
But then your offshore money needs to get a real return. Now, there are various places where returns overseas are very low. The 2-year treasury in the States is now at 1.5, and the 10 years about 1.8. We've got bonds here at 10% for the 10-year. And if inflation is going to be 6, you're getting 4% real. You're getting your inflation plus 4%. So treasuries don't beat the local bonds as far as we're concerned. So we're not going to rush out and buy treasuries just because we can take money offshore. But then we don't have an advanced corporate bond market here. And there are places overseas where we can get an add-on to that 10-year at 1.8. Maybe we can get another 3. Then it's 4.8 plus maybe the 5-6% on inflation. Now we're talking about maybe 10.5, 11. So there's going to be lots of opportunity to enhance returns above inflation because of the opportunity set. And the same thing with equities. We only got 140 equities here, but now we can go into others. But the property side, I think, is where we'll be concentrating our efforts in the shorter term. But you don't want to just take money offshore because you have liabilities here. So you now need to watch, if you're going to have a weighting above 30% offshore, you need to worry about rand strength and periods of rand strength. And we do have a cyclical economy, and the rand is quite volatile. So there's opportunity, but there's also risks coming, and we need to manage those risks.
Thanks very much, Dave. That's a lot in that answer. I'll dig into some of those elements. Murray, I'd like to bring you in here and ask, having listened to some of the comments there from both these gentlemen, does this change have an automatic implication for SA equities? Is it positive, negative? I mean, is there going to be an immediate move to take a lot of money out of SA equities and move it offshore? I mean, and you've heard what Dave said on that.
Yeah, okay. There's a lot of complexity what Dave's talking about and the way you think about it. I'll sort of try and keep it. We went back and looked at pure equity, so ignoring fixed income, commodities and that, and your efficient frontiers. And we went back to MSCI indices in the last day and a half. And the data goes back to 1970, so 51 years of data, and also looking at what Jannie's done there. And interesting enough, if you had the US MSCI index at that point in time, and over the last 51 years, SA has matched at 17% compound per year, as far as back as the data goes. And then if you optimize that, you get, based on that, just from an equity portfolio, you should have stuck to bring your risk down. You would have stuck with 41% offshore and 59 SA. So that's what that data shows. So that's the longest history we could look at. Then we've done different periods. Now, different periods give different results. It's always about your starting point. If we take in the more recent years where we've done very bad, I mean, as we know, the last 13 years, the only place to be is the US. And the US is now, is compound probably at close to 14% in dollars. It is over 60% of the MSCI World ACWI Index. But if we look the last 6 years, because South Africa has been pretty pedestrian, no growth. Funny enough, over that period, the ACWI index has done 12% and SA has done 10%. So if you optimize on that period, just on your equity component, you would have had 49% in offshore and 51% SA equities. So looking over the periods over time, what this does say, the numbers are interestingly enough, between 40 and 50 we've talked about. On a strategic basis, long run, you've got to be sitting somewhere, your equity component, you need to have probably 40 to 45% sit in an offshore bucket. So that can't be good. We run a lot of different funds, but for Nedgroup, we run the SA equity fund. So that can't be good for us long run, because what it does mean is more assets will go offshore. And We think that if you look at the Cisco, there's probably 4 trillion rands of assets. There's probably between 200 and 400 billion that would need to go offshore eventually over time. Maybe now is not the right time, but eventually. So over the next sort of 3 years maybe it's shorter. And that represents about 20 days of trade on the JSE if you trade every single share. Now, you never get that. So if you get 20%, multiply that by 5. It'll take you 5 months to do that. So that's what could be the implications. Now, one thing that's also worth noting, sort of being running the Nedgroup SA fund, is that we do a look through on how much exposure you get SA versus international. And the numbers, I mean, if we look at the banks, insurance, diversified industrial South Africa, property, we get a calc of about 38% of the index right now is SA Inc. The rest is dollar-linked, global, your Richmonds, your BATs, Naspers, etc. And if you do the same with the all-share index, you're getting about 24%. So it's a very small component that actually is SA. So you do get to pick up a lot of the global stocks, but empirically it does show that over time you need to move to the 40+% should be pure offshore equity, and SA probably 60, maybe 55, 60. So that will have long-term, will have implications on moves in the market. Short-term, however, we're in a very good space with what's happening with commodities. Our market's outperforming. We've underperformed for the last 13 years, I guess, against the US. And who knows what happens in the next 3 years. So maybe now is not the time to do it, but over a long-term, strategically, that's where I think people will move to.
So, you touched on the commodities impact there, and obviously, this change hasn't had an effect on the economic trajectory of the country or the issues that we face here. But what could, if it's a commodity super cycle or these commodity prices continue, what's the positive impact? Could that actually change the trajectory and the attractiveness of the local market?
Well, I mean, I guess most South Africans are very negative on growth going forward. And I think if we just look at the next 5 years, the projections of growth are around 1.5% to 2% is consensus. Now, so that's what, with unemployment, fixed investment spending very low and all of that. So that seems to be consensus. But I think a lot depends on what happens in the commodity cycle. I mean, we look at, in terms of our current account surplus last year, 3.5%. Historically, the last 15 years, we've run at a -3, -4%. Now we're positive. If the commodity cycle continues, obviously the platinum metal is very important, iron ore, coal. These prices seem very elevated, so I'm sure they're going to come down, but they might go a lot higher first. But I think if a commodity cycle continues in the next 3 years, SA is going to be in a lot better place. The tax receipts will be way higher, as we saw in the last 12 months, and our debt situation will improve. So we could actually see SA doing pretty well. It's surprising, I mean, the currency year to date is holding up pretty well in a risk-off environment where we still, I guess, against the pound, we're 7% stronger year to date in a big risk-off environment because we're very well placed with the commodities, what's happening.
Right, thank you. So both of these comments indicate that perhaps active managers might have the ability to leverage timing, which might not necessarily be the case for you, Jannie, in your portfolios. What would be your argument against that? And you talked about long-term investing or long-term portfolios, but how does active timing come into this decision? And you've heard what the gentleman said about is now the right time.
Look, I do think the conversation having an active fund where you've got existing shares that are at different stages of their life cycle in a portfolio is a very different conversation to having a whole basket of shares, both SA and global. So within that basket, there are all these shares that are at different stages of their life cycle. So generally, when you're running a kind of passive or rules-based fund, you don't really want to introduce timing. What you want is that long-term compounding of earnings. And so when you make a strategic change like the one we're currently facing, you would ideally like to sort of like take the timing element out of it. Of course, like Dave said, you always deal with the challenge of the currency. So, ideally, you don't want to necessarily time it, but you also don't want it right after an NE gate, etc. And so I think from our perspective in the core funds, now is neither a good time or a bad time, which is, I think, from a timing perspective, good for the core funds in terms of making those changes. I think, like I said, I mean, we are moving from basket assets to much bigger, broader assets abroad. I mean, for me, the really big plus, and then that's the one that Dave mentioned, is property. I mean, I think we run a max Reg 28 fund, the core accelerated, and that due to the offshore constraints and basically had 10% in SA property. And I mean, with these changes now, that's going to be reduced to, we'll have half SA and half global, which I think is quite a big advantage from a risk management perspective for that particular mandate.
That's a great example. Thank you. I've got a question here that I'd like to tackle in a second, but just Dave, firstly, the issue of currency is a big one here. Right? It introduces volatility. The timing of making the move, as Jannie's just pointed out, last July we were at 13.50 to the dollar. We're now sitting at it's stabilized around 15.20, but obviously it could go higher. How do people factor where we're sitting with the currency, or do you even do that? And is there a way to maybe manage that exposure if you did want to go offshore?
There are ways. The volatility is there. And the volatility can be cyclical and in the short term. I would advise against doing anything 0-1. So you fade it in, you move in slowly over a period. Now the length of period is actually quite important. It's no good doing it over 5 days or something like that. And even 5 months might be too short. So it depends where you are in the cycle. Right now with the commodities booming, you've got current account surplus. Things are looking pretty good on the trade side. But now you've got emerging market panic, and you've got asset allocators overseas selling emerging market bonds and equities, and you've got other parties having liquidity crises in the bond market overseas. There's a bond market crunch coming, so our bonds are being sold off here because people need liquidity. That's putting short-term strain on the currency, plus the asset allocators now from SA going offshore. But I would suggest that when that's over, we probably get a period of rand strength because they've done what they need to do in the short term, but the long-term current account surplus, which we're getting now with the coal price up at $400, and despite the oil price at 120, our terms of trade, you think about the oil price, our terms of trade, you think would be going the other way. But coal alone is paying for all the increase in the oil price in our current account. So we're getting all the gains in the platinum metals and gold extra. So on a day-to-day basis, we're very flush at the moment, and that will eventually put strengthening pressure on the currency. So do it slowly. Take a long-term view on it, and rand cross averaging is a very good method to make sure that you don't get hit with the volatility on the currency.
And Dave, I'll stick with you quickly to answer this question here. What are the additional asset class exposures that you can get by using the international exposure?
Well, we've got to be careful on what Reg 28 and CIS rules allow us into. So we're not allowed to go into hedge funds and things like that. So it's quite restrictive in that area. But we'll be using both funds and doing direct investment because we're wary on the impact on the TER if we go into funds and things like that. So that really needs to be worthwhile. So we're more likely to be going into direct investments, particularly for the stable fund where we only allowed 40% in equities, and there's a big gap there on property. So probably buying direct properties, it would have to be listed because we're not allowed to buy unlisted there. But that's an area which I think we'll see some asset allocation changes in the stable fund.
Yeah, we're just seeing another closure of a direct property fund in the UK because of that mismatch of liquidity of the underlying asset and the daily price. Murray, in the SA equity general sector, there's obviously two camps. There's the those are funds that can include global and those that can't. And there will be, over the next 12 months, I suggest, a divergence in the performance of those two cohorts, particularly if the Inc. Global decide to ramp up their exposure as they're now allowed to. But what factors do investors need to consider when they're choosing between the two, or how might an investor go about saying, well, okay, I'll choose SA only relative to the SA Inc. And in the first 2 months of the year, I think we've seen the SA market to the end of February was up 3.8, and global equities was down 4. So that big divergence came in 2 months.
Yeah, I guess if we look at the US market versus our market and what the currency has done, is sort of probably 18% outperformance by SA equities year to date. So hopefully it's a bit of a start. But I guess that you'll look for potentially, you'll just look for someone who's going to run your bucket, your 40%, but keep it just to equities, keep it simpler. Your 40% of buckets of equities offshore, someone runs that possibly. And then on the local side, you say, well, my 60% bucket or my 55% bucket, someone needs to run it on the SA side. So I think by default, there will be shifting of some money offshore. When the sale happens, you've got to say, well, who's going to be the buyer at the margin? Right now, I think if you look at our exchange, it's about 28% of the SA exchange is held by foreigners. So that's what the number is. So if locals are selling, someone needs to buy it. And if it could mean prices could eventually come under pressure on a longer term. Tactically, I still think in the short term, SA looks a pretty good place to be with what's happening worldwide. And that could continue for a while. But obviously longer term, people will shift. And I think the shifts, I mean, we, in our multi-strat funds, I mean, we had a discussion sort of 2 days ago about what are the implications for us. We're running 25%, about 28% offshore right now in those funds in the Reg 28, and 20% is equities. And then there's some fixed income stuff and some Africa bond in the numbers. But the average is running, I think, about 25 of SA Reg 28 funds from what we see. And so I think they're going to move easy, say, well, let's do 5 now. Let's look to do another 5 in a few months maybe, and then further out. So I think it's going to be a gradual process, and I don't think they're going to move quickly, but now's good a time to make initial start, I suppose, for them, because it's going to be an extended period. What will happen, I mean, on the dual-listed counters as well, maybe, whereas from a South African point of view, British American Tobacco, Richemont, Naspers. I mean, if you can take more offshore, maybe people are going to sell those stocks and say, well, let me buy Philip Morris. So more intention buy Philip Morris, maybe I'm going to buy LVMH rather than Richemont. So it's my choice here. So it gives you a lot more choice, I think, without a doubt. Instead of owning Anglos or Billiton, you say, well, hang on, Rio looks very cheap. Let me chop down my exposures here and let's buy some more Rios. So I think that it's going to give a lot more opportunity, I think, for the managers out there to do things like that.
And we talked about property earlier, and just alluding to what Jannie said about concentration risk in the SA market, there's been quite a bit of corporate action over the last few years, and if we see that continue, again, it reduces that number of viable companies to invest in the SA market. I mean, is that playing out still, or is it?
Yeah, there have been a lot of delistings, particularly in this probably small mid-cap space.
Right.
Obviously, we've got Distell that's just delisting now. I mean, we've got Premier who's coming to market now. Will be quite big. We have AB InBev. We're having Coca-Cola South Africa, or Africa, is coming to market as well. That'll be happening later this year, which is quite a big deal. But net, it is shrinking. But it's really, I think for the big managers, it's really the top 80 stocks is what they can plan, where the liquidity is. So, I mean, you talk internationally, whether it's 6,000 shares, there's a lot more opportunity, particularly for the big managers, to widen it out. So I think that is a positive from that perspective out there. Yeah.
Okay, thanks, Murray. And we had a question here. How does the fund risk profile change? So you showed that chart in the deviation, Jannie. So if you were to look at the changing from 30 to 45, how does that affect the overall risk profile of an end investor's fund?
Look, so within a balanced fund like a core diversified, You actually see a very similar kind of volatility profile over the long term. So that doesn't change substantially, but what you will see over time, there will be periods where that increase offshore will work in your favor from a volatility perspective, and then there'll be periods where it will work against you. And I mean, we've done that. We did that modeling with the Dimson data going back 100 years. And effectively, basically, it washes out over time. But there are sustained periods of 5 to even 10 years where having that under or overweight on the offshore side will have an impact on your relative returns. Like I showed before, the volatility over the investment period, if you stick to under like 40 to 50%, is very similar. Now, I think the other important part in terms of the modeling that I've done, of course, is that basket of shares is also diversified across different currencies, which is, again, makes it a slightly different conversation to when you are allocating individual shares to individual regions with individual currencies that's got different exchange rate with the rand. If you're moving it according to the MSCI all-country world, you're broadly getting 60% dollars, Europe, the UK, etc. So there is a little bit of diversification of that filters through, which generally means that if I take our core global fund, which is the offshore carve-out of most of the SA-based funds, you end up with a lower volatility profile within that carve-out compared to a lot of the active equivalents, and a lot of it is to do with that currency diversification, and of course the diversification over the number of counters.
Okay, thanks, Jannie. So, gentlemen, I'm going to ask you for a final comment. Dave, I don't know if you want to respond to the volatility. That I know you love volatility as a measure of risk.
Yeah, well, volatility is not risk to us, but risk will come down. Currency risk will go up because the weighting in the currency will go up, but net risk will come down because there'll be more diversification opportunities. So if the manager employs the diversification opportunities that are there, then risk will come down. But just a parting shot, both bonds and equities in SA are competitively priced at the moment, so there's no immediate rush to go offshore, especially seeing the rand may strengthen with what's happening in commodities. Thank you.
Thank you, Dave. And Murray? I
like Dave's comments. I think there's one thing is strategically on a long-term basis, this is good for the SA investor, that if we're going to move up to the 40-45%, options are way more. I think one needs to be quite carefully on a tactical point of view where we sit right now. I think South Africa looks pretty good, in pretty good space. So I think you could be surprised the returns we see relative coming out of SA in the shorter term. But over time, you will need to move more offshore.
Thanks, Murray. And Jannie, anything?
Yeah, look, I mean, I agree with Murray on that side. I definitely think it's positive for the average South African savers. I think the vast majority of high net worth individuals have already taken a lot of their investments offshore. But the average investor that only makes use of pension funds, I think this is a way to reduce the risk that's associated to their long-term retirement liabilities.
Well, thanks to all three of you gentlemen. I really appreciate your time today. As I said, exciting times in the market. So I really taking the time out to come and join us today. Much appreciated indeed.
Thank you.
Thanks, Rob.
Thanks, Rob.
Thank you all.
And to all of you, thanks very much for joining us. I really, again, to all of you, I appreciate you spending the time with us. I hope you found it useful. Some really good nuggets of information and some insights into these changes and the impacts they might have on portfolios into the future. Quick reminder that we have another insight session on Thursday, March the 10th at 10 a.m, where I'll be talking to some of our global best of breed managers about their views on what's going on in Eastern Europe. So please join us then, sign up, contact your representative from Nedgroup Investments if you haven't had the invite yet. Otherwise, thanks very much once again and have a fantastic day.